Hi, welcome to MHW TV. We are delighted to be joined today for our 2025 market update and outlook for the year. I've got Rachael co-presenting with me. Welcome, Rachael.
Thank you.
And I've got investment experts from Rathbones, Stephen Blakemore and Adrian Maxwell. It's great to have you chaps with us as well, so thank you for joining us. We're just going to start to set the scene by going back to 2024 and having a look at what the key themes were. So Adrian, you want to just talk us through what the key themes of last year were, what the market performed like, any kind of things that might carry forward to this year but were prevalent last year, and I guess a look back at the last 12 months.
Yeah, sure. So the primary macroeconomic factor throughout 2024 was really inflation. That was the key feature driving lots of equity market and bond market movements throughout the year. Inflation has moderated over the course of 2024, but remained uncomfortably high relative to central bank targets. And in addition to that, we saw geopolitical tensions throughout the course of 2024. Clearly, the Ukrainian situation is still ongoing, and tensions in Gaza that we saw flare up in 2024 also impacted markets, not least through fluctuations in the oil price, the price of energy feeding back into inflation. But despite these rather negative features, equity markets performed pretty strongly during 2024, and so these tensions and concerns are not necessarily an inhibitor of equity market performance.
Adrian, we saw significant movements in central bank policies globally. How did changes in interest rates shape market behaviour in 2024?
Yeah, so bond market activity in 2024 was really driven by, again, inflation as the key theme. In the early parts of 2024, expectations were pretty high that inflation would moderate significantly, and that would give central banks around the world space to reduce interest rates and take their foot off the brake, as it were. In the second half of the year, inflationary pressures re-emerged or didn't dissipate in the way that we're anticipating. And as a result of that, bond markets sold off again in the back end of the year, and we're now sort of at levels that we saw back in 2023.
Adrian, as stock markets do generally have their ups and downs throughout a year, can you just talk us through which sectors performed better than others last year?
Yeah, so starting with the good news first, technology was the primary driver of global stock market returns, really, and driven by, you'll have probably heard the expression, the Magnificent Seven, the top largest tech names in the US. The proliferation of artificial intelligence, AI, spending on that, and the proliferation of the use of that within company contexts really buoyed enthusiasm for that theme and carried all sort of technology names up with that rising tide. In addition to that, and connected to the point about bond markets that I talked about before, financials performed strongly in the second half of the year as interest rate expectation cuts were pared back. And obviously, higher interest rates are good for bank margins, and so financials and banks in particular performed strongly. On the flip side of that, the worst performing sectors were consumer discretionary. The inflationary pressures that we're all feeling has led to a bit of a curtailment in some of that discretionary spending. And particularly the luxury names struggled a little bit in 2024, partly on the back of Chinese softness and the influence that the Chinese consumer has in that luxury space. The other areas that struggled a little bit in 2024 were interest rate sensitive names. So as interest rate expectations dissipated throughout the year, the likes of utilities and property investments struggled over that period.
Adrian, were there any geopolitical or economic shocks that stood out as game changers last year for investors?
I'm not sure there was any sort of major game-changing influences. I think, as I talked about there, the rise of AI will be a secular trend that we see emerging over a number of years. So that's something we're paying close attention to and indeed investing in. But I think one of the features of markets in 2024 was just elevated volatility. And I think that made, from a point-to-point performance perspective, quite a good year feel quite uncomfortable along that journey. We would expect that volatility to continue. given some of the things that we're perhaps going to talk about later. But there's certainly some reasons to be optimistic about the outlook, albeit the road is not likely to be anything other than bumpy, I'm afraid.
So Stephen, coming on to you then. We're looking ahead to 2025. What are your expectations for economic growth in the next 12 months?
Global economic growth in 2025, we expect that to moderate. There's several key factors in place. So recession risks. So advanced economies like the US and Europe may face recessions due to high interest rates, debt levels, and recovery lags from previous shocks. We've also got to factor in China. So we had a bit of wobble in China's economy, so we're expecting a slow recovery from that due to structural challenges, but stimulus measures may come through, and that could boost domestic consumption and global demand. And finally, inflation and central bank policy. So central banks may adopt a cautious approach, balancing inflation control with growth stimulation.
To talk through that a little bit more, interest rates do remain to be a hot topic. So with central banks, do you think they'll pivot towards rate cuts, or do you think they'll hold steady?
So in the early part of the year, I think they'll hold steady because they're having this cautious approach to interest rates. But in terms of what would happen to equity markets and bond markets if there was cuts on held steady, so if there was rate cuts, we think the equity market will react positively, and that will be a boon for growth stocks because there'll be lower borrowing costs, and that could boost consumer spending and business investments. If there was to be held steady, you'd expect more volatility in the equity market, and that would benefit sectors like utilities and healthcare. Bond markets in particular, so if rate cuts was to come through, you'd expect bond prices to increase and yields to come down, especially longer duration bonds. If they was to be held steady, you'd expect yields to remain elevated, but the bond market would focus on credit quality.
You touched on bond yields there, Stephen. It's been a focus for many investors. What is your take on where yields are heading generally in 2025? Is it an attractive time for investors right now?
I think it is an attractive time for fixed income investors. Where we think yields are heading, so they're going to be impacted by three things. So that's central banks, inflation, and growing economic growth. So central banks, we expect them to keep rates steady in the early part of the year, and cuts may come through later in the year. So that could benefit yields coming down and prices going up. But inflation is expected to moderate. But if we have any supply shocks, that could push yields higher. So it is kind of a mixed bag out there. And global growth, if we start to see economies like the US and Europe slow down, that could impact yields, bring them down as investors move to safe haven assets. So yes, we think 2025 could be a good time for fixed income investors.
Great.
Stephen, what risks do you see on the horizon that could derail markets in 2025? And are there any opportunities that investors should be keeping an eye on?
Yeah, there's risks and opportunities. So in 2025, there's several risks that are out there. So geopolitical tensions being one, Russia-Ukraine, US-China tensions, and Middle Eastern stability. Persistent inflation, that could lead to higher interest rates. Economic slowdown and recessions, and climate change-related disruptions. So these risks could cause volatility, hurt growth, and increase market uncertainty. That being said, there are investment opportunities out there. So technological innovation, AI and robotics, green technology, so renewable energy, electric vehicles, and fixed income investments, because those high yields are very attractive at the moment. Investors should focus on growth sectors like AI and green energy while diversifying to manage risk and capitalise on long-term growth.
Gents, we mentioned opportunities and risks there in the answer from Stephen. Adrian, I'd like to just expand on Rathbones specifically, really, and look at your own investment philosophy. Where does that stand, and how is that well positioned for the coming year?
Yeah, I mean, I think our philosophy is really about understanding our clients first and foremost, and by having a deep and good understanding of client circumstances, objectives and risk profiles, we can then devise an investment strategy that's suited for not just the circumstances, but then adapt that to the economic conditions that we're in. I think from our investment proposition, we're very much international, global investors, so we're looking at opportunities set right around the world. We're looking at sustainable business models. We're looking at all the things you would expect from the financial capabilities of a business, the structure of their balance sheet, their growth potential, and crucially, the valuation that you're paying for that opportunity. I think our approach is really about sustainable wealth preservation and wealth creation. We're not looking to make a quick buck, although we like doing that as well. And so really it's about deep understanding, sensible portfolio construction, focused around risk management, and thinking about the correlation of assets as well as the opportunity set within them.
Thanks, Adrian. How do you approach balancing risk and reward in a client's portfolio, especially in uncertain times like these?
Yeah, that's a really good question. I think there's always risks, as the first thing to say. I think I've been in this game for 20 years, and I don't think there's been a single year where there hasn't been something to worry about. Some greater magnitudes of concern than others. But across that period of time, equity markets in particular have delivered really strong returns for our clients. So having some concerns is not necessarily unusual or something to be frightened of, but it is something to be managed. The way in which we construct portfolios, mixing liquidity type assets with equity type assets and diversifying assets, is really key to managing those risks. We actively manage our portfolios on behalf of our clients, so we can respond to changes in the macroeconomic environment. We can take advantage of individual investment opportunities and really be nimble around the way in which we position portfolios for our clients. So I think we're aware of risks and certainly very much focused on them, but it shouldn't be a deterrent for long-term investors.
Touching on some opportunities and potential barriers, I guess, in some ways, sustainability and sustainable investing is becoming more and more popular with our clients, and I'm sure yours too. Can you just tell us how Rathbones as a company incorporates ESG into your own strategies and philosophies, please, Adrian?
Yeah, sure. I mean, I think the history of Rathbones has a culture of ESG as it's known now, but philanthropy as it was sort of dubbed previously. So the history of Rathbones is very much embedded in societal reform. The family founders of Rathbones were involved in the abolition of the slave trade, for example, setting up university establishments and healthcare provision in communities. So there is a rich history within the business of championing these factors. Today, in our modern investment management business, ES&G factors are given as much credence as the financial analysis that we do on companies. A part of that is our commitment to environmental, social and governance issues, but actually it poses potential financial risks in terms of the outcomes for our clients. You'll have seen historically disasters at companies, oil spills, for example, have a significant financial impact on that company. And so you don't necessarily have to be an eco-champion to understand that it provides potential opportunity for risk. The flip side of that, as Stephen alluded to before, is that there is opportunity in the transition of energy as we move into a cleaner fuel environment. The social aspects, we consider working practices of companies, and we do a lot of work looking into the supply chains of the businesses that we invest in. And governance, I think, is the more easy of the three. Companies nowadays are not allowed to get away with poor governance, albeit some still try, and we certainly lobby against that. So ESG as a theme is not going away. I think it's ebbed and flowed a little bit, but it's certainly a factor that we're embedding in every part of our investment decision making.
Stephen, in an age where many investors can use robo-advisors or manage portfolios themselves, what unique value does an investment manager bring to the table?
Rathbones offer a unique value proposition versus robo-advisors and self-managed portfolios. So we offer personalised expert guidance that is tailored to clients' goals, risk tolerances and financial situation. So unlike passive robo-advisors, we offer active portfolio management. So that is changing the portfolio where we see market trends changing. So that is a big benefit. So where passive you are kind of locked in. You've got to keep making decisions on the overall fund. We're making active decisions, investing directly. So we use comprehensive risk management strategies, including diversification, that's spreading across the asset classes. We also offer emotional discipline. So during market volatility, we help clients stick to long-term plans rather than making jumps in and out of the market. And with ongoing proactive communication, we give regular updates to clients to keep them on track with their financial strategies.
Stephen, you picked up on something really interesting there when you've talked about emotion in investing. And I really am interested in drilling down into that, of how you go about making decisions and helping clients really not get carried away and overconfident in bull markets, but also not panic in the downturns as well. How would you help a client navigate investing in that way?
Yeah, so at the early onset, we set clear investment objectives. So this is aligned to personal goals like retirement, helping clients resist short-term movements. So we have regular communication and education. So in terms of helping clients understand what's going on in the economy, and again, trying to prevent those short-term reactions. We offer behavioral coaching as such, so helping clients through these emotional market volatile times. We reinforce patience and discipline and the importance of sticking to a long-term plan. So we try and get clients to understand what their risk tolerance is, and then we kind of bring that in and how we manage portfolios, and that can help us build a diversified portfolio and reduce emotional reactions during downturns. We discourage clients making emotional reactions and helping clients focus on the long term and educating them that market cycles are temporary. And we emphasize the value of staying invested for the long term and getting that compound growth.
Stephen, communication's critical. How do you make sure that clients are kept informed and that they're confident in their investment strategies?
Yeah, so we provide comprehensive, actionable updates quarterly. So they've got to see the performance in there and they can see the adjustments we've made to the portfolio. We personalise communication, so that can be tailored one-to-one meetings, telephone calls and emails to discuss the portfolio performance and how we're reaching the goals for the clients and addressing any concerns that they've got. So we've got transparent reporting. So the reports that they get are easy to understand and detailed at the same time. We offer regular market insight and commentary. So we provide regular updates, either webinars or face-to-face, about what's going on in the markets. And again, those educational resources. We do videos, webinars and guides to help clients understand financial concepts, building confidence in their decisions.
Thanks for joining us today and going through some of the key highlights of last year and hopefully what will happen this year. We move on then to talk about predictions, which is a favourite bit of mine, I guess, really. Start with Adrian, looking beyond 2025, going into the future, really. You know, if you had a crystal ball, what are you thinking are some of the mega trends? We've touched on technology. It'd be great to hear a bit more about that. But stuff that will shape markets over the long term, the next 5 to 10 years, that's when a lot of our clients are really looking to as a time frame, and it'd be great to hear more about what the future holds for them.
Yeah, I think there's certainly a prism that we're looking through in terms of our investment decision making around those key mega trends that you asked about there. I think there are a few obvious ones that people will be familiar with, and perhaps some less obvious ones. So some of the examples of what we're thinking about in terms of those overarching geographical and economic themes. Demographics is a key aspect in that. Most countries around the world are suffering with an aging population. That poses fiscal problems for governments as people are living longer and there's not enough people coming through the bottom end to support those aging individuals. But from a company perspective, that provides some opportunity for the likes of the pharmaceutical sector. If we're all living a little longer, we're all going to be taking a few more medicines as we get there. And so there's some growth potential in that. Also, the sort of the development of drugs and the efficacy of those drugs is getting better and better. and technology perhaps can play a part in that, and AI through modelling of those trials and things can be potentially quite revolutionary in the pharmaceutical sector. So that's one area we're looking at. Energy transition is another key aspect, as we talked about before, about ESG. The environmental aspect is a challenge for us all. And the emergence of new and clean fuel technology. Obviously, we've got electric vehicles as part of that solution chain. Perhaps hydrogen comes into the mix there. More efficient jet fuel is perhaps another area to look at. And the way in which we consume energy as well, perhaps, is another way to look at things and become a bit more efficient there. So certainly looking at the dynamics in that space. We've also got the digital transformation, which is perhaps the most obvious one that most people will be most familiar with. And we talked before about artificial intelligence proliferating into large swathes of our lives. And so that's certainly a key mega trend that we're paying close attention to, and indeed are already investing in. In addition to that, we have sort of a more global issue with geopolitical shifts that may occur over time. The most live one we've got is President Trump coming in the US. Big change from the Biden administration. We've seen Trump before, but maybe he'll be even more bold this time. And certainly that will lead to some volatility in markets, we think. Interestingly, the Republican Party has control of the White House, the Senate, and Congress. And so that will be a new dynamic for the US Constitution. Elsewhere, looking at Europe, there's a little bit of flux going on at political power seats in Europe. Germany and France as the powerhouses of Europe, seeing instability in the control there. We've obviously had a change of government in the UK here. So there's quite a lot of political shift going on. One thing I would say about that is that history tells you that while it's important to pay attention to these things, it doesn't have an outsized influence on market dynamics over the long term. And so in terms of portfolio positioning, we're very much aware of it, but it actually doesn't have an outsized influence on portfolio positioning.
Stephen, technology continues to disrupt industries. Are there any specific innovations or any sectors that you're particularly excited about?
Yeah, so the technology sector as a whole is very exciting. There's a number of areas within it, as you say. So first and foremost, everyone's AI and machine learning. So that's going to revolutionize industries from healthcare, finance and manufacturing and logistics. But also on top of that, there's biotechnology and genomics. So gene editing, cell therapies, biomanufacturing, that's advancing healthcare and offering breakthrough treatments that's promising rapid sector growth. Quantum computing is one that's just come out as well. So that's poised to solve very complex problems like drug discovery, logistics, finance, AI. That's another significant long-term growth potential. Two other ones we've blinked into before in ESG, so sustainable and green technology, so renewable energy, energy storage, carbon capture, and sustainable agriculture as well. So these are critical to addressing the carbon crisis that we're in and offering financial opportunities for investors. And finally, increased digitization. So we're going to have cybersecurity at the front and foremost of what we do to protect data. So that can be AI-driven, cloud protection, and privacy technologies, which will be crucial to protecting data and presenting growth opportunities for investors.
Thank you, gents. Just be really interested as we wrap up now in any final words of wisdom you've got for us as we embark on this year of investing and looking after clients once again. Stephen, firstly?
Yeah, so in a word, I would say patience. In an environment of constant change and rapid innovation, the key to long-term success is maintaining a disciplined approach. So focusing on the fundamentals, resisting the temptations to react impulsively to short-term market movements, and sustainable growth can often take time. So staying patient allows investors to capitalize on emerging trends and weather inevitable volatility.
And Adrian, any final words from you?
I think Stephen summed it up nicely there. But what I would say is, if you've got some questions, you should come and talk to Markland Hill and Rathbones, and we'll help you out.
Thank you.
Thanks, Adrian and Stephen. Thanks for sharing all of your insights and your wisdom today. It's been really informative, learnt lots, and I'm sure that our clients will now have a much clearer understanding on how to take things forward throughout 2025. Stay tuned for some more discussions, and as always, thanks very much for joining us.
Thank you for having us.